Attention! What I'm about to reveal in the next few minutes could completely change your relationship with money. April wasn't just a turbulent month. It was a watershed moment for those who knew how to see beyond the chaos. When Trump announced global tariffs, panic set in. The market fell like an elevator with no brakes, and you know what happened to most people? They froze in fear, watching their wealth melt away in real time. But I'm going to show you exactly what I did differently. While everyone else was running away, I spotted a pattern that very few investors noticed. A pattern that turned this crisis into a gold mine for my dividend portfolio. In the next 7 minutes, I'm going to show you step by step how I strategically invested in stocks that now deposit money into my account every month without me having to do a thing. And no, this is not for millionaires. I started with an amount that any determined person can amass. If you stick around until the end, I'll share the 3 signals I use to spot these opportunities before they disappear, including one that's happening right now that 99% of investors will miss. The decision is yours. Keep doing the same old thing and expect different results. Or figure out how to turn times of crisis into steady streams of income. Don't skip any part of this video. Every minute could be worth thousands in your financial future. So, it wasn't just watching the storm, it was dancing in the rain. Check it out. I put no less than $35,500 into the market, and at the same time got rid of $25,000 in stocks that no longer made sense to me. Doing the math, this means that I injected $10,000 clean straight into the vein of dividend stocks. In other words, more fuel on the fire to make my assets grow and generate that passive income that everyone dreams of. While some were paralyzed by fear, I was rebalancing my portfolio, optimizing gains, and strengthening my positions in companies that really put money in my pocket. And what are you waiting for to upgrade your investments and stop leaving money on the table? Every day that goes by without a clear strategy is a lost opportunity to build your financial future. Take this vision. I remember that April morning vividly. The coffee was still warm on my desk when the notifications on my phone started going off. Apple stock, which had been my safe haven for years, was swinging wildly. This wasn't just another volatile day, something bigger was happening. For 6 years, I held Apple as a core position in my portfolio. I followed every product launch, every investor conference, every quarterly report. It was almost a personal relationship. Many of my investor friends would ask me, "How do you sleep soundly with so much exposure to one company?" And I would always confidently answer, "Because I know Apple's DNA." But that morning, as I looked at the numbers more carefully, I realized something had changed. Not at Apple. It was still the same brilliant company it had always been, but in the context around it. Valuation had reached stratospheric levels. A PE ratio of 32x, well above the historical average of 18x. For a company that size, this meant the market was already pricing in years and years of perfect growth. I opened my spreadsheet and started doing the math I rarely did for Apple. How much of my annual income came from its dividends? The answer was surprising and uncomfortable, just 0.48%. For a position that represented almost 12% of my portfolio, that was a paltry return in terms of cash flow. And then came the final blow, news of Trump's new global tariffs. As I watched the press conference, I felt a chill run down my spine. Apple, with its supply chain deeply rooted in China, was directly in the firing line. This wasn't just about shrinking profit margins, it was about the complete disruption of a business model that had taken decades to build. That night, I couldn't sleep. I was about to make one of the most difficult decisions of my investing journey. The next morning, I sat down with a cup of tea, even strong coffee wouldn't be enough at that moment, and started mapping out alternatives in the technology sector. I screened more than 15 companies, looking for those that combined 3 essential factors: reasonable valuation, limited exposure to Chinese tariffs, and crucially, a track record of dividend growth. After hours of analysis, I identified 3 candidates that met all the criteria. The moment of executing the sell order was almost physical. My finger hesitated over the confirm button for almost a full minute. This wasn't just a financial transaction. It was saying goodbye to a company that had been part of my journey for so long. But the numbers didn't lie. And as I always tell my followers, investing is not a romantic relationship. It's a rational decision based on data and future prospects. When fundamentals change, our allocation needs to change too. Over the next few weeks, I reallocated capital to technology companies with more attractive valuations, lower exposure to China, and better dividend growth prospects. The result? My passive income increased by 22% with the same capital, and my exposure to geopolitical risks decreased considerably. This experience taught me a valuable lesson. Even the best companies in the world can become bad investments when they are mispriced or the outlook changes. The discipline to constantly review your positions, question your own beliefs, and be willing to change direction is what separates consistent investors from those who are stuck in the past. What about you? Are you reviewing your positions with the same analytical rigor, or are you letting potential risks slip by due to emotional attachment to certain companies? Have you ever had to make a difficult decision like this in your investment journey? Share your experience in the comments. I'm genuinely curious to know how you handle these crucial decision moments. Continuing the portfolio optimization, an in-depth analysis of all existing positions was conducted, with a special focus on companies that showed red flags across multiple performance indicators. Disney, for example, showed significant deterioration in its key operating metrics, an 8.7% decline in streaming segment revenue over the last 2 quarters, a 12.3% increase in customer acquisition costs, and a 3.2 percentage point reduction in consolidated EBITDA margin. In addition, the company faced an increasingly challenging competitive landscape, with new entrants to the streaming market investing aggressively in original content, which further pressured its margins. T. Rowe Price, although it had relatively solid fundamentals, represented only 0.8% of the total portfolio, an allocation insufficient to justify the time and resources required for adequate monitoring. The return contribution analysis showed that even an exceptional performance of this position, for example, a 20% appreciation, would result in an impact of less than 0.116% on the total return of the portfolio, characterizing allocative inefficiency. The decision to liquidate these positions was based on rigorous quantitative analysis using a proprietary scoring model that evaluates 14 distinct factors, including revenue growth trend, 3 years, margin expansion contraction, return on invested capital, ROIC, industry competitive intensity using the Herfindahl-Hirschman Index, regulatory risk exposure, and dividend growth potential, among others. Both Disney and T. Rowe Price scored below the established minimum threshold of 65 points on a scale of 0-100, with 58 and 61 points respectively. From a capital management perspective, the liquidation of these positions freed up approximately $18,500, which was strategically reallocated to opportunities identified as scoring above 80 in the assessment model. This movement resulted in a projected 1.7% increase in the portfolio's annualized return. Assuming a 5-year investment horizon and using conservative growth estimates. Additionally, the tax aspect was carefully considered. The sale of Apple had generated a significant capital gain of $12,350, which would have been fully taxable in the current tax year. by realizing the accumulated losses on the Disney for $200 and T. Rowe Price 2,800 positions, it was possible to offset $7,000 of this gain, reducing the tax liability by approximately $1,680, considering the applicable marginal tax rate of 24%. This tax loss harvesting strategy was executed in compliance with IRS regulations, respecting the waiting period required to avoid the wash sale rule. The portfolio's efficiency has also been improved in terms of diversification. The average correlation index between assets has been reduced from 0.68 to 0.61, indicating a better risk distribution. The projected Sharpe ratio for the portfolio has increased from 0.72 to 0.79, reflecting a more favorable risk-return relationship. The implementation of this optimization strategy followed a strict execution protocol, with limit orders strategically positioned at predetermined price levels, minimizing market impact and ensuring execution within a 0.3% range of the established target price. All transactions were completed within a 3-business-day period, taking advantage of favorable liquidity windows identified through intraday volume analysis. Holding inefficient or underperforming positions can be a significant drain on your overall returns, not only because of the opportunity cost of tied-up capital, but also because of the dilution of analytical focus and the potential distortion of the portfolio's risk profile. A quantitative analysis conducted by J.P. Morgan Asset Management showed that portfolios that undergo regular optimization and rebalancing processes outperform, on average, 2.1% per year over those that maintain static positions for extended periods. Do you have a clear strategy based on objective and quantifiable criteria to divest assets that no longer fulfill their role in the portfolio? Sign up now to access our complete portfolio analysis and optimization methodology, including spreadsheets and exclusive tools that automate this critical decision-making process. Continuing the strategic restructuring of the portfolio, a particularly significant acquisition was the incorporation of Alphabet Inc., Google, into the portfolio. This capital allocation decision was informed by a comprehensive multi-factor analysis, with particular emphasis on the company's historic announcement of the commencement of its regular dividend program. On April 25, 2025, Alphabet announced its first quarterly dividend of $0.20 per share, representing an initial dividend yield of approximately 0.5% based on the stock price at the time of the announcement. While the initial yield may seem modest when compared to sectors traditionally associated with high dividends, such as utilities, sector average of 3.8%, or REITs, sector average of 4.2%. A deep analysis of Alphabet's financial fundamentals reveals extraordinary potential for sustained dividend growth over the coming decades. The company has an exceptionally low payout ratio of just 9.7%, significantly lower than the S&P 500 average of 35%, indicating ample room for future increases without compromising growth investments or balance sheet strength. Alphabet's cash flow analysis demonstrates an impressive capacity to generate free cash flow, FCF, with $69.8 billion in the last 12 months, representing a FCF margin of 25.3% of total revenue. This metric exceeds the technology industry average by 11.7 percentage points. Additionally, the company maintains a net cash position, excluding all debt, of approximately $110 billion, providing a substantial buffer and flexibility for consistent dividend increases even in adverse macroeconomic scenarios. Alphabet's earnings growth has been remarkably robust, with a compound annual growth rate, CAGR, of 23.7% over the past 5 years, driven primarily by the exceptional performance of its digital advertising platforms, Google Search and YouTube, and the accelerated growth of its cloud computing division, Google Cloud, which reported a 37.2% year-over-year revenue increase in the most recent fiscal quarter. The company's operating margin expanded from 22.5% to 29.8% in the same period, demonstrating significant gains in operational efficiency and economies of scale. Financial modeling, using conservative assumptions of revenue growth, 15% CAGR over the next 5 years, decelerating to 10% and then 7%, moderate margin expansion, 30 basis points per year, and continued share buybacks, approximately $15 billion per year, suggests that Alphabet has the potential to implement dividend increases in the range of 18–25% annually over the next 10 years. This scenario would position the company among the dividend aristocrats of the future, with a potential yield on cost of over 3.5% over the next decade for investors who establish positions now. The decision to allocate 8.7% of the portfolio's total capital to Alphabet, making it the fourth largest position, was calibrated through a Markowitz optimization analysis, considering the asset's historical correlation with other portfolio components, 0.62 on average, its beta-adjusted volatility, 1.12, and its potential to contribute to compound dividend income growth, estimated at an additional 0.92% to the portfolio's total annual income growth. From a valuation perspective, Alphabet trades at a forward PE multiple of 21.8x, representing a premium of just 8.5% to its 5-year historical average, despite its superior growth outlook and new policy of returning capital to shareholders. The PEG ratio, price earnings to growth, of 0.92 indicates an attractive valuation when adjusted for projected growth, especially when compared to the average of 1.37 for large-cap technology companies. Sensitivity. Analysis performed across multiple macroeconomic scenarios, including interest rate changes, inflationary pressures, and global economic slowdown, demonstrated that Alphabet maintains a defensible competitive position and margin preservation capacity even in challenging environments, due to the essential nature of its digital search and advertising services for companies of all sizes. The incorporation of Alphabet into the portfolio also represents a strategic diversification within the technology sector, complementing existing exposures with a company that has multiple growth vectors: artificial intelligence with Google DeepMind and Gemini, cloud computing, mobile operating systems, Android, video streaming, YouTube, and emerging initiatives such as autonomous vehicles, Waymo, and health technologies, Verily. Are you on the lookout for companies that are initiating or consistently increasing their dividends as a way to boost your passive income and long-term wealth? Growth. Early identification of future dividend aristocrats, such as Alphabet, can represent a significant competitive advantage for investors focused on growing income. Like and comment on the video, and I will respond in detail on how to identify these candidates before they become widely recognized by the market. Moving on to the next strategic move, capital was directed toward the midstream sector with the acquisition of shares in MPLX. This decision was driven by two main factors. First, the attractive dividend yield of over 8%, which stands out in the current investment landscape. The second factor is the compound annual growth rate, CAGR, of dividends at 10.7%, indicating a strong potential for growing passive income over time, providing the predictability and stability that income-focused investors seek. MPLX, a subsidiary of Marathon Petroleum, specializes in natural gas transportation and processing infrastructure, a critical and strategic segment for the global economy. In a context where demand for energy and renewable sources is rising, the infrastructure for natural gas transport, often seen as a transition energy, becomes increasingly relevant. Therefore, MPLX not only offers a robust income stream through its dividends, but also allows investors to participate in the growth of a sector essential to both the energy and economic future. The advantage of investing in infrastructure companies like MPLX lies in their resilient business models, as the transportation and processing of energy resources are perennial needs for any economy. Moreover, these companies often have long-term contracts, which ensures greater stability and predictability in their revenue streams. In the case of MPLX, its asset portfolio includes pipelines and natural gas processing plants, which are critical components in the energy sector's value chain. This means that even during times of economic volatility or energy market fluctuations, MPLX has a solid foundation to generate consistent returns. This type of investment also aligns with strategies of diversification and passive income generation. Diversifying into essential sectors like infrastructure helps to reduce overall portfolio risk, as the performance of these assets tends to be less volatile compared to more speculative stocks or those tied to cyclical sectors such as discretionary consumption or technology. For investors focused on predictable cash flow, MPLX becomes an appealing option, particularly given its track record of consistent dividend growth. To further diversify the portfolio, both geographically and in terms of income profile, an investment was made in Hess Midstream, HESM. This company stands out for its quarterly dividend increases and consistent growth, intrinsically linked to its oil operations located in the northwest region of the United States. The acquisition of HESM aims to add a growing source of income with exposure to a geography and market dynamics that are distinct from other midstream positions, such as MPLX. The search for diversification within the same sector, but with different growth vectors and regional exposure, is a tactic to mitigate risks and capture different opportunities. Have you explored diversification at different levels within your portfolio, including geographic and subsector diversification? Continuing with the acquisitions focused on dividend growth, the portfolio was strengthened with the inclusion of two technology giants, Salesforce, CRM, and Microsoft, MSFT. The investment thesis for both lies in their robust cash flows, low payout ratios, percentage of profit distributed as dividends, which suggests room for future increases, and a consistent history of increasing dividends paid to shareholders. These companies represent a bet on dividend growth coming from established companies in the technology sector, which demonstrate the ability to generate value continuously. Investing in market leaders with solid balance sheets and progressive dividend policies is a good strategy that you should consider for the long-term growth of your passive income. Additionally, a small position in Texas Pacific Land, TPL, was established to gain long-term exposure to the oil royalties sector. TPL operates on a royalty-based business model, which implies minimal operating costs, overhead. A 5-year track record reveals an impressive total return of 740% for the asset, in addition to the payment of special dividends, which reinforces its potential as a long-term investment with distinct characteristics within the energy sector. As a result of these strategic moves and new acquisitions, the portfolio's projected annual dividend income has now reached $5,547. This represents an increase of approximately $1,000 in annual dividend income. On a daily basis, dividend income has reached $15 to $20. Future plans include continuing to build high-yield positions in pursuit of a robust and growing passive income stream. And so, we come to the end of this strategic journey through the turbulent markets of April. As you saw, while many investors were paralyzed by the chaos caused by Trump's tariff announcement, I saw a unique opportunity to restructure my portfolio and maximize my passive income. With a net investment of $10,000, I made difficult but necessary decisions. I sold Apple, despite its iconic status, due to its high valuation and exposure to Chinese tariffs. I eliminated positions like Disney and T. Rowe Price that were not performing as expected. And most importantly, I redirected that capital into extraordinary opportunities. From Alphabet, which has just begun its journey as a dividend payer, to MPLX, with its impressive 8% yield and 10.7% annual growth. From Hess Midstream, which brings us geographic diversification, to Salesforce and Microsoft, technology giants with robust cash flows. And let's not forget the small but powerful position in Texas Pacific Land, which has delivered a total return of 740% over the last 5 years. The result? My annual dividend income now stands at $5,547, an increase of approximately $1,000. That's $15.20 coming into my account every day, working for me while I sleep, while I travel, while I live my life. But here's the truth that few want you to know. This is just the beginning, and you can do the same. If you are tired of seeing your money sitting idle, yielding less than inflation, if you dream of building a source of income that grows year after year regardless of your work, if you want to learn to identify opportunities where others only see chaos, now is the time to act. Subscribe to the channel now and activate the bell. Every week, I share strategies like these that can completely transform your relationship with money and investments. Don't put it off. Every day that passes is one less day receiving dividends that could be going into your account. Like this video, so that the algorithm shows it to more people who, like you, deserve to know the power of growing dividends. And comment below what your biggest discovery was in this video. I will personally answer the most interesting questions. Remember, while others wait for the perfect moment, truly successful investors create opportunities in any scenario. Will you just sit back and watch, or will you start building your financial future today? See you in the next video. Until then, may your dividends continue to grow.